In this segment, we will be discussing savings and investments. Let's begin with stocks. Stocks are pieces of the corporate pie. When you buy stocks or shares, you own a slice of the company. The stock market represents all the companies that sell their shares to the public. It is the primary place for companies to obtain financing for their operations and for investors to profit on the growth of those companies. There is therefore a close relationship between the stock market and the economy as a whole. Thousands of companies in the United States, known as public companies, invite individuals, their parents, relatives, and neighbors to become part owners. They do this by selling shares of the company. When an investor buys a share of a company, he or she receives a stock certificate or additional documentation that proves stock ownership. There are two types of stock shares, common and preferred. When investors own a public company's common stock, they are entitled to vote in the election of company officers as well as other important matters, and they often receive dividends on their shares. Since common stock is often riskier than preferred stock, it offers greater potential returns and losses. Shareholders of preferred stock don't usually have voting rights, but receive a fixed dividend, or share of a company's profits, which is paid to preferred stockholders before common stockholders are paid. However, owners of preferred stock pay for that privilege. Usually their dividends won't increase when the company's profits increase. When a company does well, the price of its preferred stock tends to underperform the common shares. However, when a company fails, its preferred stockholders recoup their investment before common stockholders, assuming they can recoup anything at all. The terms large cap, mid cap, and small cap refer to the issuing company's market capitalization, that is, the overall value of all shares of the company's stock. A company's size or market capitalization is one factor to consider when you decide which stocks to buy. Capitalization is calculated by multiplying a company's outstanding shares by its current stock price. For example, a company with 100 million outstanding shares at a current market value of $25 per share has a capitalization or market cap of $2.5 billion. Growth stocks are shares of companies exhibiting relatively fast growth in earnings, which generally causes the stock price to go up. Growth stocks are the most volatile and can fluctuate rapidly because growth companies are typically in new or fast-growing industries such as the high-tech sector. Growth stocks are considered riskier and often pay lower or no dividends, but appeal to investors who will accept more volatility and risk in hopes of greater appreciation in share price over time. Income stocks, on the other hand, are characterized as those that would pay high and regular dividends. Stable and well-established industries, including utilities and financial institutions, typically produce income stocks. Blue chip is the name applied to a stock of large, well-known, well-established companies with good reputations. Value stocks are those considered to be selling at lower prices or undervalued because the companies that issue these shares have had business setbacks or are out of favor with investors. Stocks are often referred to by a combination of the characteristics we've just discussed, such as shares of a small cap value stock or of a mid cap growth stock. When investors buy bonds, it means they have loaned money to a company or the government. In return, that company or government promises to repay the amount borrowed plus periodic interest payments. Corporate bonds are issued by publicly owned companies, while municipal bonds are issued by state or local governments. Municipal bonds are publicly traded debt of cities and states. The interest payments are free of federal taxation. The capital gains and losses are, however, taxed like any other gain or loss. Interest is free of Missouri income tax if the bond is issued by Missouri or a city within Missouri. The taxable equivalent yield is shown below. Whichever side is the greatest is the one that you should invest in. The price of a bond will fluctuate with interest rates. When interest rates go up, prices of currently trading bonds go down, and vice versa. If the bond is held to maturity, the investor will receive an amount stated on the bond known as the face value. For example, if you buy 5 corporate bonds at $1,000 each and the bonds mature in 20 years, even if the value of the bond changes over the period of time they are held, the bonds will be worth a total of $5,000 at the time of maturity. In addition, the borrower may promise to pay you an interest payment twice a year for 20 years. The declared annual interest of the bond is called the coupon rate. Bond investors may take advantage of several different marketplaces. Most individual bonds are bought and sold in the over-the-counter or OTC market, although some corporate bonds are also listed on the New York Stock Exchange. To purchase a new bond issue, a financial professional will provide the bond's offering statement, the prospectus. It will spell out a bond's key terms and features as well as the risks involved. Investors can also buy and sell bonds that have already been issued. This is known as the secondary market. Many dealers keep inventories of a variety of previously issued bonds. Bonds sold in the over-the-counter market are usually sold in $5,000 denominations. In the secondary market for outstanding bonds, prices are quoted as if the bond were traded in $100 increments. Thus, a bond quoted at 98 refers to a bond that is priced at $98 per $100 of face value or at a 2% discount. More information about bond market investing may be found at www.investinginbonds.com. A mutual fund invests the pooled money of its shareholders in various types of investments. The fund manager buys and sells securities for the fund's shareholders. Mutual funds are not risk-free. Their values rise and fall along with the securities in the fund. The shares in a mutual fund are priced by dividing the current market value of investments owned by a mutual fund by the number of mutual fund shares. As the value of the securities in the fund goes up or down, the value of each share changes accordingly. Benefits of mutual funds for the beginning investor include diversification, professional management, low-cost shares, and liquidity, which means that shares can be bought and sold easily. More than 8,000 different mutual funds are available on the open market. The investor should learn the objective of the fund, what securities the fund owns, the level of risk, and its earnings record as compared with similar funds. The fund objectives are stated clearly in the prospectus, which is the legal document describing the fund. Most mutual fund companies require a minimum initial investment, sometimes as low as $250, but often quite a bit higher. Mutual fund shares trade very much like stocks, rising and falling in price depending on investor interest and the performance of stocks in the fund. The net asset value of a mutual fund indicates its value or price per share. Like stocks, mutual funds are liquid, which means they can be easily bought and sold. There are three main categories of mutual funds. Stock funds invest in stocks, but stock fund portfolios vary depending on the fund's investment objectives. For example, some stock funds invest in well-established companies that pay regular dividends. Others invest in younger, more growth-oriented firms or companies that have been operating below expectation for several years. Like bonds, bond funds provide income. Unlike bonds, however, these funds have no maturity date and no guaranteed repayment of the amount you invest, in part because the fund's holdings have different terms. On the plus side, though, you can automatically reinvest your dividends to buy more shares. And you can buy more shares in a bond fund for much less than you would need to buy a bond on your own, and get a diversified portfolio to boot. For example, you can often invest $1,000 to open a fund and make additional purchases for smaller amounts. You can find a hybrid in balanced funds that invest in both stocks and bonds. Money market funds seek to maintain their value at $1 a share so that they're described as cash equivalent investments, though they are not FDIC insured and you could lose money. You earn interest on the investments the fund makes, but don't have capital gains or losses. Most money market funds let investors write checks against their accounts. In that way, the fund resembles interest-bearing checking accounts, but typically pay higher rates and charge lower fees. Before investing in a mutual fund, you need to find out if it's a load or no-load mutual fund. Load funds charge a sales commission, while no-load funds do not. When a sales commission is paid going into a mutual fund, that's called a front-end load. A commission paid when you sell is known as a back-end load. In theory, the advantage to paying a load for a fund is that there are usually staff members available to explain the fund to potential investors and advise them as to the appropriate time to buy more shares or to sell. For new investors, it might be worth paying the commission for the extra guidance. With some no-load funds, an employee merely takes your order to buy or sell or can only offer limited support. The investor is fully responsible for understanding the investment. Even a no-load fund may still charge a 12b-1 fee to cover the sales and marketing expenses involved in operating the fund. More information about investing in mutual funds may be found at www.morningstar.com. Managed funds have professional management that attempts to outperform the market index. This is very difficult to do year after year. Regardless, past performance is often used to market these mutual funds to investors. Passive funds also have professional management, but they only purchase stocks in the market index. These are often lower cost and their performance tends to match the market. Increasingly, it is shown that for most investors, buying a mix of passive index funds will provide market returns. There are many common mutual fund statistics. For each, a positive number is good, and the larger the positive number, the better. Alpha is a measure of historical manager effectiveness while controlling for market risk. The Sharpe ratio indicates a measure of return per unit of risk, which is measured as the standard deviation of the fund. The Trainer's ratio is a measure of return per unit of risk, which is measured by the beta of the fund. For each, we must not forget that these measures are created from historical information and performance and may or may not reflect the future. Beta is a commonly used term that measures how volatile an investment is relative to an index. The average is 1, values greater than 1 are historically more volatile, and values less than 1 are historically less volatile. This presentation was made possible by the Secretary of State's Office as well as the Investor Protection Trust.